Welcome to Investors Insights. Our topic today, earning respect. I'm joined by my distinguished colleagues, Trey Booth, Bobby Norman, and Ty Miller. We've just finished a great meeting. I always enjoy these meetings and debates. Today was really interesting in terms of the way everybody came together looking at it from different perspectives. So, Ty, you came up with the title. You inspired us, Earning Respect. Talk about corporate earnings. Start us off.
Yeah, it's hard to believe, but we are basically wrapping up second quarter earnings, over 90% complete. And so, it's a good time to look at the results and see where we stand. Earnings growth was outstanding for the quarter, up over 50%. There's not many quarters where you have 50% growth in earnings. Now, there were some kind of wonky things where some of these big companies invest in these other bigger private companies, and the valuations change. But if we factor that out, earnings growth was still over 30%, which again is a spectacular quarter. And
Very
that's
much
something
so.
that,
Yeah, that's excellent.
Outstanding. And that's one reason why, the stock market has hung in there despite being a midterm year, despite all of the circumstances we've seen this year. And so earnings being strong is something that, is really telling and has moved the market. That's something that we're going to keep an eye on for the rest of the year. But what's going to be interesting is as we move into 2027, you will move into the period where you start comparing earnings from the previous year. And with them being so strong this year, it can affect earnings. Next year, we've already seen a little bit of a decrease from expectations of about 17% earnings growth. Now we're expecting more like 13%, just because some of these earnings may have been pulled forward into the year. That's something that we'll keep an eye on. And then also Treasury rates being up is something that we want to keep an eye on for earnings as well. So great news right now, but great news right now leads to tougher comparisons for next year and something we want to keep an eye on.
Very much so. And it's been a topic all year. We've talked about it in our blogs. People keep asking, how high can the stock market go? That's why I was fascinated by what Bobby brought up in the meeting this morning, too, in relation to what you're talking about, CEO confidence. CEO confidence gives a good indicator as well. So earnings have been spectacular. Can we continue that pace? Bobby, can we continue having the confidence that we've seen because CEOs are starting to voice some issues?
Yeah, I want to give an update on the CEO confidence ratings. It's one of the many indicators we follow to get an idea of where the economy and corporate earnings are heading. And you can see in this first chart that the CEO confidence ratings in August actually turned slightly higher. And this reading looks at CEOs' thoughts on the economy looking forward for the next 12 months. The next few charts show where CEOs that were surveyed believe profits, capital expenditure spending, hiring, and revenues are all heading higher for the next 12 months. And as you can see in the charts, CEOs believe all of these metrics will be higher in the next 12 months. So if this holds true, it would be a good environment for markets to continue to show strength. And so we'll continue to watch CEO confidence levels to see if any concerns arise from higher rates and political uncertainty around the upcoming election. But so far, CEOs like what they're seeing.
Yeah, and these are two topics. Ty and Bobby, you can chime in here, but these are two topics that can turn on a dime. Agreed?
Absolutely.
Yeah, absolutely.
Yeah, and so we're looking at that every day. So we like uptrends here at Five Plan Partners, but we watch it closely to make sure the data doesn't change on us. And let me say this, as people constantly go, how high can this stock market go? What about valuations? What about earnings? What about CEO confidence? So often they forget about the bond market. We'll have people always like to talk about stocks in social gatherings or when they're in our meetings with us. But bonds, you got to watch what's going on at the Treasury. And a lot is going on at the Treasury right now, as well as the Fed. And Trey, you came in. Here we've got all this momentum. Talk about what's taking place at the Treasury and the impact of that.
Yeah, absolutely. Thanks, Greg. So, yeah, talking about the topic of respect, I think last week, a lot of financial media put a lot of focus on what the Federal Reserve was doing on ending their bond purchases. And I feel like there was in the thought there was that the Fed is not going to be directly intervening in the bond market anymore. And that should let the bond participants decide where interest rates were. There's been a phrase called bond vigilantes back in the 80s and 90s, where the bond market was more powerful than the presidency, and that when interest rates went up, it meant you had to cut spending. And so the bond vigilantes became very, very popular.
Very much so. You're bringing back a lot of memories here.
That's right. Yeah, very, very infamous. Well, in terms of respect, it sounds like the Treasury Secretary, Scott Bessent, didn't wanted to influence, push his influence on the bond market. He may be the most influential bond vigilante still trading. He announced after the Fed announced they were going to not intervene in the bond market, the Treasury announced they were going to intervene in the bond market, increasing their potential purchases of up to $20 billion. Now, this isn't the same as the Fed intervening, because what the Fed does is it creates new money and buys bonds. What the Treasury is doing is right now they're issuing short-term bonds, 3-month T-bills or things under a year, and buying long-term bonds, which are less liquid. So they're taking short-term and buying long-term. So the long-term debt has a higher yield, and so they're trying to keep that long-term interest rate capped, and they're willing to issue debt on the short end. If the Treasury dips into their savings account, which is called the Treasury General Account, which has about $1 trillion in it, then that would be creating new money. And so interesting to see how the bond. So we've seen the interest rates on the long end go up, and that clearly made the Treasury Department unsettled, and so they intervened and started buying long-term debt. They do have a big bank account to do that. Right now, they're issuing short-term debt, but that is a signal to us that the Treasury was uncomfortable where things were going. However, it does reduce the natural market signal to Congress and to the presidency. If interest rates can't go up, then how is the market supposed to signal that deficit may be out of control? And so interesting stuff happening. All this, remember, Congress is on recess. We were talking a few weeks ago that the House and the Senate all are on recess right now, and that the 2026 midterm elections really start to focus on the market starts focusing on politics once they get back in September. Well, the Treasury clearly didn't like the idea of nothing happening on recess, so really stepped in. In addition to that, though, while Congress is on recess, we had a big announcement over the weekend on trade. We hadn't really been talking about tariffs. I feel like that moved to the back pages. That moved back to the front pages this weekend with the Prime Minister, the Canadian Prime Minister, John Carney, pulling out of negotiations over the weekend, or called off negotiations. And what that did is that effectively put 50% tariffs on Canadian goods. Now, that's the headline. You're going to see 50% tariff on Canadian goods, and you think, wow, that's an enormous number. But really, under the headline, it's not that big of a number, because while we do import roughly $450 billion worth of Canadian goods, only $20 billion of that 450, which is about 4.4%, is actually subject to these tariffs. So a very small fraction in terms of overall GDP and overall impact. But the headline, I think, will pull a lot of eyeballs, and I think we'll get talks back going for sure.
Yeah, and then you're bringing up another good point here. It's why we do the vlogs. People hear the headlines, and we like to drill down on the data. And what are those headlines really telling you? And we think that's very important. It's also a way for us to bring anxiety down. And so also when you're out socially, you're talking to business colleagues, people around you, family members, you can confidently quote some of these things and let them know that's not as big a deal as everybody's making it out to be in the headlines. So we hope you treasure the information that we bring to you on this vlog. We prepare for it. We want to bring you outstanding information. And also, you need to have an understanding, a knowledge, a confidence yourself on how we're making adjustments in your portfolio and why we're doing that. So with that in mind, stay tuned. The year's not over. We've almost finished August and getting ready to go back into September. I have more people talking to me about markets and football season than year end. So it's a time we'll stay focused on. We will keep you updated through our social media. And again, as always, I have to conclude by saying thank you for believing in us, and also for sharing this vlog with people around you, because it's opened up doors for us, and it's also allowed us to help others bring their anxiety down. Take care. Have a great week. Hopefully the summertime is going to cool off, and we'll move forward. Talk soon.